Red alert, the plumbing of the financial system is completely seizing up as SOFR hits the highest level this year and the dollar tanking to a 3-year low. Are we in the early stage of a 2019 repo rate crisis repeat? SOFR just exploded higher to 4.51, the highest level this year and way above Fed funds. Banks are scrambling for cash like never before and no one has any. But wait, it gets worse. The DXY dollar index just broke down to set up its lowest weekly close since February of 2022. So for those that have been following the channel for a while, we've been talking about this extensively for the past month or so since the TGA rebuild was announced. Well, it's happening. The dollar liquidity squeeze is here. For those that have not been following along, we will briefly define what these terms mean. Secured overnight funding rate, or SOFR for short, you can think of this as the free market derived rate or interest rate, cost of money. Now, remember, just because you might not have access to it, there is a massive overnight dollar loan market in the repo market. So for this $2.8 trillion was financed in this market just yesterday alone. So while you might not have access to it, this is critical to understanding the plumbing of the financial system. $2.9 trillion, basically $3 trillion was financed in this repo market just yesterday alone. Now, what we are looking at here is the SOFR interest rate, or the cost of money on a free market basis. Now, supply and demand. What we are talking about here is supply and demand of dollars. So if you are the only guy on Wall Street that has any money, any dollars, any actual liquidity, and everyone needs it, well, you get to set a higher price or a higher interest rate cost to that money, right? You can set a higher cost of that dollar that you have. That is what we're looking at here in white. Highest level this year. Remember, the Fed has kept their Fed funds rate a constant since December of last year. And then down here, what we are looking at is the spread, or the difference between two interest rates. This is SOFR minus the Fed funds rate. And what we can see is it blowing out to 18 basis points. Now, again, just very briefly, if you have not been following along, here is how the Fed sets the price of money. They use the discount window rate. This is an interest rate that the Fed controls. And what they are doing here is they're basically saying no matter how scarce dollars get, we will always provide dollars to the market at this interest rate. Right now, it's about 4.5. The reverse repo award rate is the exact opposite. They're saying no matter how overabundant dollars get, we will always buy them at this interest rate, which is currently 4.25. So the Fed is setting a ceiling in the price of money and with the discount window rate, and a floor in the price of money with the reverse repo award rate. And what we're looking at here is the difference between the free market derived SOFR interest rate and the Fed funds rate, which again, 4.33. This is the interest rate that the Fed is trying to set for that overnight basis. So this spread tells you the degree to which the Fed is losing control over the financial system. And you might be noticing the spikes from time to time. Well, here we're going to look at quarter end dates. These are the lines in blue. We can see most of these spikes have happened at quarter end. Well, why is this? It's called window dressing. Banks, financial institutions, basically moving numbers around on Excel spreadsheets to try to make their balance sheet look better to regulators or to investors. We can see at quarter end, it is common for SOFR to spike above Fed funds. Now, there's still a couple spikes you might be noticing. Well, here's month end. So once you exclude month end and quarter end, we can see that this is the highest spike in SOFR Fed funds. Remember, it is September 16th, the day of this video. This has been happening, by the way, since September 5th. This spike in SOFR above Fed funds has been happening for the past 2 weeks. And it is not the end of the month. It is not the end of the quarter. You have to go all the way back to 2020 to find a SOFR spike above the Fed funds to this degree. 5 years. Now, this spike is the 2019 repo rate crisis that arguably could have been worse than any of the other financial crises we've had. The plumbing of the financial system completely seized up, completely. Everyone needed dollars, but very few actually had them. Therefore, those that actually did have dollars got to set an enormously high price or interest rate for those dollars. On an intraday basis, this reached 900 basis points above Fed funds. And this was obviously, clearly, very quickly met by a deluge of liquidity from the Fed. This again happened in September of 2019. The Fed expanded their balance sheet, printed bank reserves immediately after. And then, of course, we know what happened in 2020 and 2021. By the way, when dollar liquidity gets too abundant, when dollars are too overabundant, everyone has them and no one actually wants them, you will see SOFR actually go below the reverse repo rate. Now, this is indicating that the Fed is losing control in the opposite direction, which is to the downside. SOFR minus Fed funds is going negative. This is indicating dollars are way too abundant. And of course, that was the situation for much of the past 5 years. Well, the Fed has been engaged in quantitative tightening. They have been reducing dollar liquidity. And as if that wasn't bad enough, by the way, here is the Fed of New York. We can see secured overnight funding rate 4.51. By the way, this is above the discount window rate, which again is the Fed trying to backstop and say no matter how scarce dollars get, we will always provide them to you at 4.5. Well, the free market is demanding a higher interest rate than the Fed's discount window rate. This is very, very rare. You can see this has never happened, at least in the history of the chart that we are looking at here. This is extraordinarily rare. Now, why is this happening and why have we been warning about it? Well, here we're looking at the Treasury General Account. This is the government's checking account. Just like you would like to have a buffer in your checking account, the government would like to have a buffer in theirs. And the balance for that buffer is $850 billion. So that is what the white line represents, the balance on the TGA, the checking account balance for the government. Well, we had drawn down the TGA enormously because of the debt ceiling. The government could not issue net new debt, and so they were forced to rely on their checking account and draw it down sharply. It got as low as $270 billion. And we have been rebuilding this TGA for a couple weeks now, for a month or two now. But the Treasury still has $200 billion left to go to get to their target of $850 billion. Why is this a problem? Well, the reverse repo is basically empty. So very briefly, what this is the balance of a account, a facility that the Fed has called the reverse repo. And what this is when there are too many dollars being printed, as there were in 2021, the Fed would like to try to sterilize those dollars to prevent them from going out into the real economy and driving inflation even higher. Now, at the peak, this reverse repo had $2.5 trillion in it. We printed an enormous amount of money during this period of time, while the Fed was trying to sterilize all those excess dollars to prevent them from going out into the real economy, chasing goods and services and prices, pushing prices higher. And so the Fed used this reverse repo facility to try to incentivize all of that excess cash at one point, $2.5 trillion, to go into this reverse repo facility and get paid. Again, remember from this chart, you're getting paid an interest rate here, which is seen here in red. The Fed was saying, bring your dollars here, we'll take care of them. Just whatever you do, do not send them out into the real economy. We will pay you interest, the reverse repo award rate, and bring your dollars here. Do not let them go push prices higher. Well, the reverse repo is empty. So this $200 billion that the Treasury still has to go in rebuilding the buffer for their checking account, it cannot come from the reverse repo like it did this time in May of 2023. Janet Yellen had run down the TGA to basically nothing, but she was able to tap the reverse repo because, again, this, you can think of it as a bucket of excess dollars that you can just basically go tap. And the same is true here, by the way. This was here in 2022, the reverse repo balance had over $1 trillion in it. And as well, with this TGA rebuild, even though it was not as high as it was back here, the TGA rebuild here in April of this year, there was at least about $250 billion in the reverse repo. So this TGA rebuild even was able to tap to some degree the reverse repo. Well, not the case now. Only 17 billion. Remember, they have 200 billion left to go. So if it can't come from the reverse repo, where can it come from? By the way, here's the reverse repo zoomed out. We can see this is the lowest level the reverse repo has been at, going all the way back to 2021. Well, if it cannot come from that tank of sterilized excess dollars that had been printed way above and beyond which we actually needed, if it can't come from that facility called the RRP, it has to come from somewhere else. Well, it has to come from the financial system. Here we're looking at bank reserves. Now, remember, the Fed creates bank reserves when they are engaged in quantitative easing, which is where the Fed is printing money out of thin air and then using that money to buy assets like U.S. Treasuries and mortgage-backed securities from the banks. And what happens is the Fed deposits those bank reserves in the account for that the bank has at the Fed. And in exchange, the Fed gets assets. And what we're looking at here in white is the value of the assets that the Fed owns. And then in red, we are looking at bank reserves. Now, remember, bank reserves are 1/2 of the monetary base, or M0. This is official government money. M0 includes currency, which is created by the Treasury, and then bank reserves, which are created by the Fed. And here in red is the bank reserve balance, currently 3.1 trillion. Well, if the rebuild for the TGA cannot come from the reverse repo, there is no more sterilized excess dollars just sitting around waiting to get tapped. It's got to come from bank reserves, currently at 3.1 trillion. Well, another 200 billion would take this down to about 2.9 trillion. Well, we know that M2 money supply is growing. So down here in red, we're looking at the share of bank reserves as a share of M2. We can see currently 14% of M2 is accounted for by bank reserves. Well, the last time that it got down to 13%, 2 weeks later, you had the regional banks, three of the four largest bank failures in U.S. history occurred. We had a bunch of regional banks failing. Now, liquidity conditions were certainly tight as bank reserves are being drawn down during quantitative tightening, right? So QE, the Fed is printing money and getting assets. QT is the exact opposite, which is they are letting those assets mature and roll off the balance sheet, and money is being destroyed. We can see that bank reserves have come from $4.25 trillion down to just 3.1 trillion. So bank reserves are being destroyed during quantitative tightening, just as bank reserves are being created during quantitative easing. Well, the last time that bank reserves as a share of M2 got down to 13%, we had three of the four largest bank failures in U.S. history. I will also note that down here in 2019, we, of course, had the repo rate crisis when bank reserves as a share of M2 got down this low. Now, similar story. Going into that, the Fed was engaged in quantitative tightening. We can see the balance sheet was coming down and bank reserves were coming down because the Fed was engaged in quantitative tightening during 2017, 2018, and 2019. Then, of course, we see the repo rate crisis here in September. And what happened? The Fed balance sheet started moving higher. It went from about 3.77 to about 4.2 trillion. So the Fed printed a lot of money even before 2020 and 2021. That is what happened. Now, it should be noted that the liquidity conditions were certainly tight during those regional bank failures, but there were other contributing factors as well, like long-term treasuries. The regional banks had loaded up on those, and they were sinking in value. And so there were other components that led to those regional bank failures. They did not have enough actual liquidity. They had all these long-term treasuries, but those long-term treasuries were down 40%, and they were forced to sell them because there was a run on deposits. And when they went to sell them, they were only worth about half of what they thought they should be worth, or if they had held to maturity, what they would have been worth. Well, they couldn't hold them to maturity. They had loaded up on 30-year, 20-year U.S. Treasuries. They needed cash now because people were coming and demanding their deposits. They were forced to sell them. They were forced to sell at a massive loss. Therefore, they were ended up going insolvent, and that was a huge driver of the regional bank failures. But it cannot be ignored. The effect of dollar liquidity. Again, we saw it down here in 2019. We were looking at that earlier. And then, we do have a bit of a warning of what might happen. Because remember, the TGA rebuild has to come from bank reserves. So 3.1 trillion, call it, it'll go to about 2.9 trillion. Well, we know M2, which is the denominator here, is growing, which means that this red line will fall. The share of bank reserves as a share of M2 might dip to 12 or 13% if the Treasury is insistent on continuing to rebuild the TGA. Now, if this SOFR spike continues, we might see them abandon that. We might see the Fed say, "Hey, we're going to engage in balance sheet activity. We're noting liquidity strains." The meeting, by the way, is tomorrow. Well, actually, the meeting started today. The press conference is tomorrow, so we might see that. Now, again, today's tax deadline, so we really have to wait and see whether or not this continues into tomorrow. But the effect on assets that this might have, we will look at here. So here's the effect on assets, and we'll take a look at the dollar in a second, dipping to a 3-year low. So here is S&P 500, and I have overlaid the SOFR Fed Funds spread. We can see that generally speaking, a lot of drawdowns occur around the time of a SOFR Fed Funds spread blowing out. Now here we're going to look at Bitcoin, and we can see the same thing with Bitcoin. We will also look at the VIX. Here is the VIX. And we can see that it is also common for the VIX to spike when the SOFR Fed Funds spread is blowing out, meaning, again, that the free market is saying there's not enough dollars and too much demand, right? So the very few people that actually have dollars get to set the price of money, and the interest rate for that money moves way above the Fed funds, again, indicating that to some degree the Fed has lost control. And then finally, here is the DXY dollar index, and you can see the correlation between SOFR Fed Funds spread and the DXY dollar index. Now, the DXY dollar index, speaking of, is breaking to a 3-year low. You have to go all the way back to 2022, to January, February 2022, to find the dollar breaking to these levels. Now, this is something, again, that we've been watching for a long time now, and we've been talking about the bearishness for the dollar, especially on the weekly chart here. You can see all of these candles just looked just horrible. The chart has been looking ugly. Well, it is breaking down below a trend line, a support line that goes all the way back to after 2008 to 2010. This is a 15-year trend line. And on a monthly chart, we can see that the DXY dollar index is breaking down below the trend line. This is a critical trend line for the DXY dollar index to hold. Now, remember, I will point out, we'll zoom out here. Look at the 6-month. The dollar on a purchasing power parity basis is actually even more overvalued today, while at least at the end of 2024, than it was here when the DXY dollar index was pushing 160. The dollar on a purchasing power parity basis, as measured by the IMF, is actually more overvalued at the end of 2024 down here at, call it 105 or 110, is even more overvalued there than it was over here. The dollar is structurally overvalued, grossly overvalued. And of course, this administration is keen on reindustrialization. Well, to do that, you cannot have an overvalued currency. This is why, by the way, the U.S. is the only country that is dumb enough to want the reserve currency status. This gets into Triffin dilemma and Dutch disease. You see every other country on earth going, no. Our currency is getting too strong. We are going to manipulate, do whatever we can, like the Swiss National Bank. We saw them engage with this. The Swissy was getting too strong. And so the Swiss National Bank went in and took interest rates down to try to disincentivize capital flows into their currency. And the same thing is true with the euro. ECB officials have been saying, look, the euro is getting too strong. 120 is our line in the sand. Any stronger than that, we might intervene in the currency markets because, again, when you have an overvalued currency, what that means is no one can afford to buy your goods and services on the international in the international market on the global stage. So we will continue to watch the DXY dollar index. This is a very significant move. The fact that this is breaking down and would be the lowest weekly close in 3 years. But it is worth mentioning that generally speaking, when you have liquidity squeezes, you generally see the DXY dollar index move up. This is notable for the fact, and tied with the earlier topic that we were talking about with SOFR, the fact that you were seeing a sell off in the dollar, and it is coming at the exact same time that there is a funding squeeze, a dollar liquidity squeeze or shortage in dollar liquidity. So generally, you will see the DXY dollar index pop as dollars become scarce. Well, we are seeing the exact opposite of that this time around. So, anyways, hopefully that was helpful. Definitely something to keep an eye on. Yes, it is tax deadline yesterday, so we will wait and see how this settles out over the next couple days. But hopefully that was helpful, and I will catch you in the next one.